All right, so let's begin the show and let's discuss about sectors and the right way to have sector exposure in your financial portfolio, be it through sector-specific stocks or sector-specific funds. What exactly should you be looking at in terms of what sector should you be looking at? What should be the strategy? How can you prevent over-diversification in case you have an allocation in the form of sector-specific stocks or sector-specific funds? What exactly should be a profitable strategy for you? Let's get on board Aditya Agarwal, co-founder Wealthy.in. Aditya, good evening. Welcome to the show. A lot of buzz around going on sector-specific action in the market, looking at the current volatility, market not being able to sustain on the high levels. But then having said that, what kind of sectors? We are also looking at the quarter numbers now. What specific sectors are you looking at which might outperform in maybe a few quarters' time?
Right. Thanks, Kavita. Always a pleasure being here. So I think sector investing is obviously very interesting, sometimes very exciting because all sectors go through their cycles. And if you catch a sector in its right cycle, then you can make outsized returns. But that's also the downside of it, because if you catch a sector in the wrong cycle, then you end up sort of not making, not able to generate as much as, Sensex or indexes in returning. So if you look at like the way you can look at sectors is two ways. One way is to look at sectors that are poised for long-term growth, right? That are, for example, financial services, one sector in India. We still have a long way to go in financial services, right? So if you take that as a sector, we will see continued growth in the sector in the long term, right? Then lately, because of Indian government's focus on manufacturing and because of focus on sort of Indianizing defense, those are a couple of other sectors where you can look at manufacturing or units that are linked to PLI schemes or defense sectors where you can actually see in long term reasonably good outperformance, right? But in short term, it's very hard to sort of predict in a couple of quarters which sectors is going to have a great run and which sector is not.
All right. Let's chalk out or mark out a basic difference between sector-specific stocks and sector-specific funds. Just give me a very basic understanding of these two aspects of investment which you can incorporate in your portfolio.
Right. I think so. Basic difference is same, Kavita, right? So, for example, if I'm, let's say, picking up stocks on my own versus I'm trusting a professional fund manager to pick stocks for me. So, for me, let's say as an investor, I believe, let's say, pharma is poised for growth, right? I fundamentally believe that next 10 years we could have really large pharma companies in India. So, I'm bullish on pharma as a sector, but I may not be so confident as to what companies are the best companies in pharma, which companies, because every company goes through a different dynamics, right? So I might sort of trust a fund manager through a mutual fund route rather than trying to sort of go down it on my own. Like similarly, right? Like I might trust small cap, right? But if I don't have bandwidth or time to find the right small cap companies, I'll end up choosing a fund manager. So it really depends on you as an individual. If you think, like sector specific calls, ideally you should make out of your own research, right? Or you should be out of your own conviction. After that, if you don't have the time, bandwidth, research, skill,
all right. So
energy,
Aditya, let's just twist this question and let me ask you, what kind of an investor should be adopting a stock-specific approach for sectors, and what kind of an investor should be looking at sector funds?
So I would say someone who can spend time screening stocks, someone who can spend time doing research. So my thumb rule is that if you can't give 5 hours a week to do research, then you are better off going with a professional fund manager who can do that research, right? So basic thumb rule is that. And secondly, some people don't have the skill set to read a balance sheet, right? Or to be able to read analyst reports, right? So if you don't have both, then it's best. And most people know that either I have both or I don't have both as individual investors. If you don't have both, you should definitely go down the route of fund manager.
Let's consider a case where Aditya, an investor, has sector-specific stocks and also sector-specific fund. What could be the case of over-diversification in this kind of a portfolio?
There's a very good question, Kavita. I think, in fact, we see people sort of missing that point. So if you look at, it's very easy to, first thing is you should calculate the overlap, right? So, and that's very easy to calculate because if you 100 rupees in two stocks, and so 50-50 in those two stocks, and if you're 100 rupees in fund, then you can go to that fund's fact sheet and find out which all companies are invested in, right? So if you end up seeing that, it might end up being that all of your 200 rupees in those two companies only, because, let's say a fund is also invested in those. So then clearly you are sort of under diversified, right? And similarly, if you sort of have 10 stocks bought on yourself, and then you also have the same 10 stocks in mutual fund, that also means that you're over diversified, right? So you should ideally look at, essentially, if you're picking up stocks on your own, you're bullish on sector, maybe you can pick up the top 3 players in the space, right? And sort of invest on those stocks on your own. And if you're going down the mutual fund route, I have personally myself, I've seen that, mixing the two doesn't really work well. Either you go down the stocks route or you go down the mutual fund route. One of those approaches you should prefer, rather than mixing the two approaches.
Also, this is the case of over diversification that we just considered. Also, how can you be adequately diversified while investing through stocks or funds in a sector specific exposure? How can you intelligently place it? I mean, that's a strategy, a tricky strategy for almost those kind of investors who have a very core portfolio ready and in place. This is for the investors who understand the market, who have a time frame for a particular sector, they understand the sector and also have the risk appetite which is in line with the sector risks involved. So how can you intelligently place sectors, get yourself very well diversified in terms of across the sectors through a stock strategy and a mutual fund strategy in one portfolio?
Right. So in stock strategy, I think it's fairly, one, you can follow a simple rule, right? So for example, if I'm, let's say, bullish in banking sector, right? So I would pick up, let's say, if I'm investing stocks directly, then I would say, okay, let me look at 2 top private sector banks, 1 public sector bank, and 1 small bank, which could potentially become big in the future, right? So those 3, 4 stocks could sort of complete my banking or financial services portfolio, right? That's one way to sort of, have the right kind of diversification. If I'm investing in a fund, of course, that fund is sort of taking care of diversification, right? So similarly, it's very similar to, for example, investing in Indian stock market, right? That I would have, let's say, some allocation in large cap, some in mid cap, some in small cap. So the same approach you can take for your money towards when you're allocating in a particular sector. If you're picking up stocks on your own, just sort of diversify across large cap, mid cap, small cap. That's one way to do it. Second way to do it, as I said, is through, essentially, like as I said, right, like if you're banking, you can pick up one, couple of public private sector banks, one maybe public sector banks, and one maybe a bank which is new, or which is sort of, let's say, small finance bank, but can become a big bank in the future, right? So that's the right way to sort of diversify and, have a very, very sort of robust diversification strategy, even if you're picking stocks on your own.
In the current scenario, the kind of sector-specific stocks or mutual funds that you might want investors to think about to have an exit strategy from, any red flag on any specific sector?
No, I personally don't do any sector-specific recommendations, especially exit, because, India as a country, we are at 6-7% growth trajectory. So all sectors end up contributing to that growth, right? So if you're an equity investor, if you have 4-5 years of horizon, all sectors will end up doing well for you. So at this point in time, I really don't have an exit call on a particular sector.
Call in a particular sector through mutual funds, maybe you might want to suggest or recommend?
Right. So I think, as I said, right, so banking and financial services funds is something that are evergreen sector, right? Pharma, of course, is going through some consolidation phase. So maybe it's time to accumulate some pharma slowly. But yeah, there's some correction sort of going on there. So, and consolidation is going on. So there's a time to maybe sort of, I think the biggest one sort of, which are very hard to sort of play, are the infrastructure sector funds or stocks, because they go through like really, really, I would say, high volatility cycles. So those ones are the trickiest ones. But yeah, otherwise, I think even, companies that are sort of in consumption sector, like, or essentially companies that are playing on discretionary spending, right? So consumer oriented sort of funds or consumer oriented kind of companies are also another good bet, right? Hotels, which, like, for example, hotels, right, as a sector, because, Indians are spending more on travel and hotels, and that's something that is continued to poised to grow. So that is another sector which, sort of investors can look at having some allocation in their portfolio.
Right, Aditya, I think that will be all. Thank you so much for taking time out and helping our viewers with their sector-specific strategies, be it via stocks or mutual funds. Thank you so much.
Thanks, Kavita.
On that note, we'll take a quick break, and post that I'll be joined by Pranjal Kamra, who's going to guide you on cutting down your lifestyle expenses and also help you how to make the most of your income and how to make the most of your life by having the right investment strategy. All of this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about your lifestyle expenses. And this is like an every month story that people have to face, where you have restricted income and you want to invest, you want to splurge, you really want to adjust your cash flow and think about it. If that's the concern right now that's bothering you, I have an expert with me. I have Pranjal Kamra, CEO of Finology Ventures, who's going to help you out on cutting down your lifestyle expenses and also help you make the most out of your income and your investments. Thank you so much for joining in today, Pranjal, and good evening. Welcome to the show. So, a very common topic, but a very crucial one, because your entire financial life or the tone of your financial life is actually set or based on the kind of lifestyle you live, okay? And the way you control your lifestyle expenses, the way you look at your lifestyle expenses, that also sets a tone about how you look at money, how you look at investments, okay, and how you look at growing your money. So what all actually comes under the bucket of lifestyle expenses? Let me just start with this very basic question.
So, say it in a very basic way, I would say lifestyle expenses are expenses that are born not out of necessity, but out of desire. So, just to give you a couple of examples, probably if you're going to a movie theater and you choose to sit in the last row lounge chair that costs 500 rupees, whereas in the same situation, you could have chosen a front seat that costed 200 rupees, the additional 300 rupees is a pure lifestyle expense. Sometimes going out with family is a necessity. So your movie expenditure could be recreation and entertainment expenses, which are partly necessary, but you choosing the most expensive seat is actually purely a lifestyle expense. Similarly, for your health, there are two ways. You could go run or walk in the park, or you could join a very expensive gym. Now that membership fee of that expensive gym is a lifestyle expense. So such expenses which are born out of desire, living a certain way, are lifestyle expenses.
But one very important aspect is that your lifestyle keeps changing and your expenses also keeps changing. You obviously aspire for a better lifestyle always, Pranjal, and so you will always see these kind of expenses going up in your life. It's very important for you to actually sit down and track all your lifestyle expenses and make a financial Excel sheet, maybe, if you want to do that. But at the same time, you also need to understand, or maybe create that difference between needs and wants. Now, that's the tricky part. How do you do it?
Oh, absolutely. I mean, sometimes, it's said that it's the easiest to lie to ourselves. Sometimes we don't even realize when subconsciously our brain is tricking us into something. It's making us believe that it's a need, and if we don't have it, we can't be happy. So, sort of subconsciously, we attach
For technical error, but then you're a very important question that we are trying to ask, Pranjal. Pranjal, can you hear me?
Yes, I can. Can you hear me?
Sure. Yeah, I can hear you now. Please continue.
Yeah. Okay. Yeah. So put it in financial terms, there is a formula to deal with it, which is called 50-30-20 rule. So that tells you that whatever in-hand income that you get in your hand after every month, divide it into three buckets. 50% is for your needs. Traditionally, what are needs? Your home, food, shelter, education, healthcare, utilities, internet, phone, and things like that. And then the next 30% goes towards your wants. Now, whether to buy a 1,000 rupee t-shirt or buy a 5,000 rupees designer t-shirt, both are desires. But how much can you spend depends on how much money is there in your 30% bucket. Whether to take the 500 rupee movie ticket or 200 rupee depends on how much money is left in that 30% need bucket. That's how you change your monthly lifestyle and also upgrade it if your planning is well. How will that planning be well? The next 20%. You keep investing it and keep seeping rewards in the long run, so that in the long run, you have more money in your 30% bucket coming in every month through passive income.
All right. So I think let's just directly go on the questions where you have tips and tricks available to, in order to help our viewers to cut down their lifestyle expenses and maybe make the most of the income. At the same time, have a better investment strategy so that if at all in future you have lifestyle expenses that you can see going up, you can splurge well and you can plan well for it. So Pranjal, over to you now.
One tip I have started using recently and has worked for me: credit cards. At times credit cards comes in various forms. They come in co-branded types, a particular brand that you really like, they come in partnership with that. And the temptation is we'll save more, maybe 2% more, maybe 5% more, but actually we end up buying more. The number of transactions that we do increase, and which causes our overall expense wallet share towards that particular expense category to increase. So I think, traditionally we are hardwired that whenever we take out our wallet and pay actual real cash, it pinches. Whereas if it's a credit card and we see that even payment from our bank is not deducted instantly, it feels like subconsciously we are getting it free of cost. So prefer UPI or debit card over credit cards, and I think monthly expenses will automatically fall, and because we'll do less of impulse purchases. Another simple way is, these days, everyone is trying to, make you set up auto debit mandates. You want to subscribe to an OTT, you don't need to do monthly payments manually. Just set a bank mandate or a UPI mandate and things will happen automatically. Sometimes when we are setting up mandates, we don't even realize, we don't even read the message that 500 rupees are being deducted every month for the past 2 years. We absolutely forget about it. So prefer manual payments over auto debits, and I think you will save on a lot of money.
All right. Now, considering that we have the festive season also coming up, Pranjal, so in order to restrict yourself from splurging or just going gaga over your credit cards and taking personal loans, strict word of caution, keeping the festive season in mind.
Uninstall shopping apps. Be it all the all the shopping apps that you see, they also have their website versions. But what happens is, if we constantly have the app icon on our phone home screen, we sort of tend to open it to pass our time. It becomes an entertainment habit. And if you keep opening it 5 times a day, you'll end up buying things. So don't compromise, don't sacrifice on your needs and desires. But if you actually need something, let it stay in your brain and then take the effort to open the website and order it, instead of you seeing the app icon 100 times a day.
All right, I think that will be all. Thank you so much, Pranjal, for being on the show and helping our viewers on how to maintain their lifestyle expenses, how to cut down their lifestyle expenses. Thank you so much. On that note, let's take a quick break. Post that, I'll be joined by Amol Joshi, who will be answering your mutual fund portfolio queries after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and now it's time to actually get your mutual fund portfolio queries answered. And with me for that on the show is Amol Joshi, founder, Plan Rupee Investment Services. Amol, good evening and welcome to the show. And before I start taking the queries, if in case our viewers want to send us their mutual fund portfolio queries, you can WhatsApp their question on 865-797-4571. That's the WhatsApp number that's flashing on your screen. We also have an email ID, which is themoneyShow@etnow.tv. All right, so let's begin. And first question of Mr. Medikonda, Amol, and he wants to know what is best for 11 years retirement plan, DPF, NPS or a mutual fund. We don't have him on the phone line, but a very relevant question. And the best mode of retirement in terms of investment instruments. What about having a mix of all of this, Amol? Will that be a great strategy?
Sure. Good evening, Kavita. Thanks for having me over on the show. Coming to the answer for question of Mr. Medikonda, The instruments that he has chosen for his 11 years retirement plan are diverse instruments. So diverse in terms of your VPF is typically predominantly a debt instrument, fixed income instrument. NPS, depending on your age or depending on the choice that you make of the fund and scheme, you can have a pure debt or a mix of debt and equity strategy. Within mutual funds also, you have the entire assortment of asset classes, debt, hybrid, that is debt plus equity, as well as pure equity. I absolutely concur with the point that you mentioned, whether a mix of all these products would work. So let's go over quickly the advantages of a few of the instruments that he has mentioned. VPF, probably one of the best instruments in fixed income because of the tax saving nature of it. By tax saving, I mean the interest is not taxable on the VPF, as well as it has substantially higher rate of interest compared to fixed deposits or compared to even PPF. So that's a very good instrument to have. Second point is you can blend a two product strategy in something like a 30-70 or a 40-60 kind of an asset allocation. 30 to 40% you can deploy your funds in VPF. Obviously, your employer has to give you that option, and remaining 60 to 70% in mutual funds. Within mutual funds, you can look at equity hybrid, or given your long-term investment horizon of 11 years, you can even look at pure equity allocation, especially if you are going to invest in a systematic manner, something similar to SIPs. You will, by doing this, you will get best of both worlds. And by taking some exposure to equity, you are likely to outpace the inflation as well over 11 years investment horizon that you have.
Amol, because we're talking about retirement instruments, it's very important for an investor to understand as to how can they also utilize these investment instruments for having a regular income post-retirement. You know, if in case you are someone who doesn't have a regular income going on post-retirement, how can you make best use of these investment instruments and have a part of your investment that's invested in these investment instruments as a part of regular income?
Right. So we covered two instruments in the previous part. Let's cover two more instruments. Let's now talk about NPS. NPS, as we all know, is National Pension Scheme. You will invest amount into NPS via lump sum or a regular manner, and you accumulate a certain corpus. Now, that certain corpus, you have two options at the end of your retirement, during your retirement, I mean. Once you retire, you can withdraw a part of corpus, 40% odd as lump sum in your hands, and remaining corpus, about 60%, you have the option, or mandatorily you have to go for annuity. Annuity we have discussed on this very show, Kavita, earlier also. Annuity is an insurance product in which you invest a lump sum, and typically the annuity rates are around 6% also. There are around 8 to 10 annuity options, but let's go with a theoretical 6%. So if you have a 1 crore rupees in your annuity, 6% of that is close to 6 lakh rupees per annum. So you'll be able to get 50,000 rupees kind of income from your annuity. That's what you will do with your NPS corpus. In mutual funds also, there is something similar. It is called as SWP, Systematic Withdrawal Plan. Now, mutual funds and annuity are two different products. Annuity rates are guaranteed. And that's why, obviously, anything, if it has to be guaranteed, the underlying instrument also have to have that kind of guarantee. You essentially invest into long-dated government securities, which do not have any default risk. In mutual funds, however, depending on the instrument, depending on the asset class that you have chosen, you can do SWP, Systematic Withdrawal Plan, to take care of your monthly expenses, or even you have monthly as well as quarterly options there as well.
Sure. Let's move on to our next question, Amol, which is from Preetham Bose. He says he's 28 years old and he wants to make long-term investment to invest till the age of 60, and he wants to know if he can take the route of mutual fund.
Yes, Preetham. Well, of course, you can take the route of mutual funds. I must compliment, at your age of 28, you are already thinking about retirement. You have a good, and retirement age you have given at 60. So you have a 3-decade plus long investment horizon ahead of you. You can typically, to build a portfolio, we would need to know your risk appetite. We would need to know what is your existing asset allocation that you follow across various instruments that you are probably investing. But even if thinking from a clean slate, let me say that if you are going to take a plunge into world of mutual funds, I would suggest, for such a long investment horizon, you can probably look at mid and small cap funds. Now, I have two recommendations for you since you have asked for the portfolio. You can invest in Motilal Oswal Mid Cap Fund. You can also, in small cap category, you can also look at Nippon India Small Cap. Now, I also want to give you certain kind of illustration or calculation. If you start with a 10,000 rupee SIP only, over next 30 or 32 years, if this portfolio generates 12% CAGR, meaning if you get a 12% return from market from this portfolio, your end corpus 32 years later will be very, very close to 4 crore rupees. So that's a significantly large amount. And of course, this 10,000 need not remain static, right? As your income grows over the years, as your career or business, whatever you are doing, as you earn more and more, you can also utilize something called as SIP topper. Your SIP can increase from 10 to 12 to 15 and something like that. So you will have a significant corpus at your hands after 32 years. My best wishes to you.
Amol, just one question. So a mid-cap and a small-cap fund, any other way of diversification, because he's just starting out his journey into mutual funds, and you think an index-based approach rather than going aggressive with mid-cap and small-cap would be better for him? Because we don't have all the details also of an investor and the risk appetite he has. He's just 28, I guess, that's the information we have. But what kind of is it better to have a diversified strategy?
Right. So, Kavita, you're absolutely right. Again, we do not have all the details. That's point number one. And point number two, Preetham specifically asked about mutual funds, and that's why. So, coming to diversification, so it is not necessary to have diversification within mutual funds also, although mutual funds offer you wide variety of asset classes from debt, fixed income to equity. Even there are some funds that invest into global or international equities, and then you also have gold and silver funds. Other than that, I assume if you are a regular salaried employee, I'm sure that you do have a PF deduction component in your salary. Other than that, if you have some element of, if you have already started with PPF, that accounts for your overall diversification. But as you rightly pointed out, I would also suggest do not start with entire 100% investments into equity. You can certainly make a mix of traditional fixed income instruments. It could be PF deduction or it could be PPF, and remaining component you can go towards long-term investment horizon in the schemes and asset class that we discussed just now.
We move on and let's take Jignesh Hari's question. He says he's 41 years old and he's invested in large cap, large and mid, small cap and ELSS mainly for wealth creation, and he says the investment has taken care of inflation also. He's investing 15,000 per month, wants a corpus of 3 crores in 10 years. Again, not a lot of details, but then the way he's written down the question, he looks like he's sufficiently diversified. Okay, but 3 crores in 10 years with the investment amount of 15,000, do you think he really needs to step up his investment?
Yes, Kavita, that's right. Mr. Jignesh, if you're listening to this, you can also do some back of the envelope kind of rough calculations. Your SIP of 15,000 a month you would be investing a total of 1.8 lakhs per annum. And over 10 years, your capital investment is going to be about 18 lakhs. Now, this 18 lakh to become 3 crore in 10 years period of time looks very, very difficult. It is nearly impossible. Now, coming to actual hardcore numbers, your 15,000 SIP over 10 years in mutual funds that you have invested into large and mid cap, small cap and ELSS fund. If these schemes cumulatively generate a 12% kind of CAGR from the markets, you also mentioned something to take care of inflation. So yes, over 10 years, SIP mode of investment, I'm very much hopeful that it will be inflation beating, all things remaining constant. Now, this amount is actually going to accumulate only about 33 lakhs for you. So you have to actually jack up your SIP by 9 times or even 10 times to reach your desired corpus of 3 crore rupees. There are two things you can do. Either you increase your SIP by 9x or 10x. So your SIP will have to be something like 1.35 lakhs per month or 1.5 lakhs per month. If that's not possible, then you actually have to probably take a help of a professional and realign your goals to reflect the, reality. I think those are the two ways that you can take. But from this amount, it's very difficult, nearly impossible to get to your goals. Your goals should be very good idea to have financial goals, but goals also should be realistic, matching with the kind of input that you are going to invest into mutual funds.
All right, Amol, we move on and we will take Praveen's question now. And Praveen says that his goal is to build wealth for retirement till the next 15 years now. And he wants you to evaluate his portfolio. Okay, so Parag Parek Flexi Cap, Kotak Emerging Equity, Quant Mid Cap, Nippon India Small Cap, Quant Small Cap, ICICI Nasdaq 100 Index Fund. And he's doing an SIP in all these funds.
Right. Kavita, total of all the SIPs for Praveen is about 1 lakh rupees per month. If we simply go by 1 lakh rupees per month, we'll come to schemes also, of course. This 1 lakh rupee SIP over 15 years, that's your investment horizon. At the rate of 12% CAGR, you can accumulate a corpus of about 4.75 crores, about 4.5 to 5 crore. That's the kind of corpus that you can look forward to. Coming to your portfolio, you have a significant exposure to mid and small caps. Your exposure is about 50%. You also have flexi cap and international fund for diversification. I would say you can cut down your small cap exposure from 2 schemes to 1 as you reach closer to your financial goal. So 5 years from now, you will have only 10 years in your hand. By that time, this exposure from 50% should gradually come to 40%. From there, it could come to 30%, and you can settle somewhere between 20 to 30% as you go towards your end goal. I would say, and my last comment about the one of the funds is, instead of choosing Nasdaq fund or Nasdaq composition, I can advise you to look at more broad-based index, something like S&P 500. So those are my recommendations to you on scheme, and you will be able to achieve significant corpus of about 4.5 to 5 crores if you continue with these investments over next 15 years.
All right, let's move on and let's take Indresh's question, Indresh Singh. And the funds that he has in his portfolio, Amol, are Canara Robeco Blue Chip Equity, PGM India Mid Cap Opportunity, Parag Parek Flexi Cap, SBI Small Cap, SBI Contra Fund, Canara Robeco Small Cap Fund also. And he wants to understand if any changes that you might want to recommend. And he's also eyeing a corpus of 10 crores in 20 years. Is the investment amount enough, or he needs to step up?
Right. I think it's a slight, Idresh might benefit from the one of the previous questions that we answered in this very show. Idresh, your SIP investment per month is about 10,500. You have reasonably long period of time of 20 years, so it will get you a nice compounding. But we cannot look away from the fact that, just like the previous example, you are investing about 1.8, 1.9 lakh rupees per annum. And even over 20 years, your total investment itself is hardly about 35, 36 lakh rupees. From that amount to getting to 10 crore rupees is a significant jump. As per my calculations, you will be able to accumulate a corpus of about 96 lakh rupees. So let's call it 1 crore rupees. So you are 10 times away from your stated target. What you will have to do, again, there are only 2 things that you can do. One is increasing SIP by 10x. So instead of 10,000, your SIP should go to, as high as 1 lakh rupees per month. If not, then you have to, back calculate. So now I like when people kind of want to accumulate a lump sum of 2 crore, 5 crore, 10 crores. These are nice numbers as goalposts. But when you say you want to accumulate money for any particular goal, it could be retirement, it could be child's education, the better way, instead of looking at a 2 crore, 5 crore, 10 crore lump sum, the better way is what is the current expense. Suppose if you are accumulating money for a child's education, and if so-and-so course today costs you about 40 lakh rupees, over next 5 years or 10 years, you should add element of inflation to that number and get to a realistic figure. So I would say, if you cannot increase your SIP 10x to 1 lakh rupees per month, you have to realign your target, you have to make it more realistic, and there are ways of doing it that I explained to you just now. Look at what kind of amount you will need, inflation adjust it over a period of 20 years, which is your goal, and then accordingly start investing.
Move on and let's take Kota Venkatesh's question, Amol. And the fund mix in the portfolio is SBI Small Cap, Nippon India Small Cap, Tata Small Cap, Axis Small Cap, Navi Nasdaq 100 Fund of Fund, Quant Flexi Cap. He's 43 years old, tenure or investment horizon is 20 years. The goal is 1 crore. Too aggressive and over diversified in small cap. What changes would you recommend?
Right. As you rightly pointed out, Kavita, small cap, there are about 4 schemes out of 6, and amount-wise, the small cap allocation is about 80% of the portfolio. So I would say this is on the extremely high side. Your horizon of 20 years, it's very helpful. Small caps have long periods of flat returns and several years of negative returns also. If you are truly believer in the small cap story, in the equity story, you might continue, but I would still suggest tempering it back from 80% to something like more manageable 30 or 40%. That's point number one. You can reduce from 4 small cap schemes to maybe 1 or maximum 2, and the additional money you can add into 2 schemes that I'm going to recommend for you: HDFC Large and Mid Cap Fund, and I'm also going to recommend to you a hybrid strategy of ICICI Prudential Equity and Debt Fund. As the name suggests, this is a hybrid fund. It invests into equity and debt, both asset classes. And because since the fund manager has to maintain a typical asset allocation, this fund does automated rebalancing of 2 asset classes. Now, why I'm suggesting this to you is your target over 20 years is 1 crore and your SIPs of about 27,000 per month. At 12% CAGR itself, you are able to reach a significantly higher corpus of about 2.5 crores. Now, since you are in a very, very comfortable position, there is no need to take the excess risk, as well as you can look at investing into a product like equity hybrid or equity and debt fund, which will smoothen out your journey. And you will not have really, the kind of anxiety that many people have during market crashes. We saw one such market crash in very recent memory in 2020 March, where globally as well as in India, you had benchmark indices going down by as much as 35 to 40%. Since you are very, very comfortable, Mr. Venkatesh, I would suggest reduce the small cap quantity, add 1 large and mid cap fund and 1 equity hybrid fund. And best wishes to you.
With that, it's time up. Thank you so much, Amol, for being on the show today, helping our viewers
Pleasure.
with various aspects of financial planning and answering their portfolio queries. And time to sign off, but I'm going to leave you with our WhatsApp number, which is 865-797-4571, and our email ID, themoneyshow@etnow.tv. Do send us detailed information in terms of your investments, be it mutual fund or insurance or anything tax related, which you might be concerned as far as your investments are concerned. Do send us your queries and we will get your queries answered by our experts live on the show. Thank you so much for watching. Goodbye.